Okay, good evening, everyone. I hope everyone is doing great. I believe it's a wonderful evening to start our session on financial management. Okay, great. I'm sorry I was having an echo. So, I would like to have a little basic interaction with you guys before I start the class, start the session. So, we will be having a six session on financial management on the sprint. So, which is expected to have most likely most of the important things to be discussed, by the way, right? The success sprint is about only the exam oriented point of view. We are going to here learn about few major concepts of revision, and then we are going to mostly concentrate how the examination works on different types of section A, B, C. That's what we're going to mostly concentrated on. So now today I'm gonna I believe if you guys would have seen the thumbnail, it's about investment appraisal. So we are getting into that. So I myself, Kavya Ravichandran, you guys would have seen the name, and I'm an ACCA affiliate. I've been teaching multiple subjects of ACCA from almost like 5 to 6 years now. I would like to tell you guys that financial management, if you guys are writing in the December attempt, I think this session is going to be more helpful to you than anybody else. And if you're writing AFM, then the basics would be revised for you. Right. So, what is the agenda today? Since the session is going to be around for 1 hour, I would say. So let's have the basic interaction. I'm just want to have a discussion with you guys if you are really considering this class, you're attending this class right now. So first thing I would want to know that most of us who are attending the class right now are here to write the examination. I believe your concepts are already done. I mean, you have gone ahead, you have read the concepts properly, or you know the concepts properly already, is what I believe. Okay. Investment appraisal, I believe somewhere students are finding it. What is investment appraisal in the examination generally happens? We always have that mindset of not understanding the concepts properly. Then we move ahead with the uh, questions. So today what I'm going to do to just to have a revision of everything, I would like to have a basic explanation with you guys. Investment appraisal mein kya kya hota hai? Like what kind of questions that you can expect in investment appraisal, or what kind of adjustments that you can expect in investment appraisal question for an NPV calculation. This is what the major discussion that we are going to do for today and tomorrow. Okay. So for that, I want you guys to look at my screen. Yeah, my screen is what I'm expecting you guys to focus on, right? So investment appraisal, most of the student has this mindset. I believe the font should be all good, or I'll just little increase. I believe this should be fine. If you're watching from mobile also, it should be fine. Great. So let's have an understanding what are all adjustments that you can expect in investment appraisal. See, in investment appraisal, first thing that you need to know is how does the relevant cash flows works for a calculation of NPV. And then in this relevant cash flows, most likely the adjustments that we can expect is we can expect to have inflation, yeah, and we can expect to have tax allowable depreciation. I believe everybody can see my screen, yeah. Tax allowable depreciation is the other point that you can see. And you can also look into the next point as working capital injections. Yeah, working capital injections. These are all the major adjustments that you can expect to have whenever you prepare a NPV calculation or an investment appraisal question. Now, when I talk about relevant cash flows, isn't it working capital injection one of the relevant cash flows? Yes, it is. Isn't it inflation will be considered when we calculate relevant cash flows? Yes, it is. And tax allowable depreciation? Yes, of course. The understanding, apart from this, what else? The major ones are first three. And what and all minimum minus one that we can expect? You can expect to have scrap value, people. Yeah. So apart from that, you might expect some fixed cost to be coming in. You might expect to have some variable cost coming in, right? And of course, you might expect to have sales or revenue value, right? So these are all the things most likely that you can expect to have getting in an NPV question. Now, ma'am, how do we tackle this, or how do we even go through this, or how do we even understand better to solve the questions related to examination? I might not be so good at solving questions when it comes to exam point of view. I'm good at understanding the concept, but question solving is not my cup of coffee. For those students who think question is not possible for you, all I want you guys to tell us, okay, so all I want to tell you guys is right now, the relevant cash flows part. If you start with inflation, so just to have just a revision before I start with questions, people. So in inflation, you might have two different inflation. One is specific inflation. You might expect to have a specific inflation coming in for a particular cash flow, or you might expect to have a general inflation that can also be expected to have in a question. So when I talk about specific inflation, what do you mean by that? A rate of inflation which affects the specific cash flow would have been given. Cash flow would have been given. What do you mean by this? For example, wages. Yeah. So for example, wages. For example, we might expect to have, there might be specific inflation which affects variable cost. Or there might be only for sales value, there is a chance where the inflation will affect. Now, when I talk about general inflation, what is this? General inflation is the of average inflation of of an overall economy. Average inflation of an overall economy. So this is used where this is used to calculate or use in Fisher's formula. Fisher's formula for what? For calculation of rate of interest. Nominal के लिए we might use this. So you need to understand there might be two different inflation that you can expect. One would be a specific inflation, that is nothing but a rate of inflation which affects specific cash flow. For example, variable cost, wages and all of that would be considered as what? Would be considered as specific inflation. So we can expect what we can expect to have an understanding saying that now if there is a specific inflation, I'll go implement that in my rate of inflation for what? For wages, variable cost, sales value and everything. For general inflation, we use this in the calculation of Fisher's formula for the rate of interest, nominal rate of interest to be calculated. This is about inflation. Okay, guys. So now the second one that you can expect to have is tax allowable depreciations. See, most of the students will have a problem in tax allowable depreciation, which I would like to take a question for you guys to understand this. Okay. So let's have a question. I'm bringing up one of the question which is from your ACCA Study Hub called Pelta Company. I would like to present that on the screen first. the information given. So yeah, I believe somewhere the screen is visible for everybody. Guys, yeah, I will not be able to put the so much information on one screen. So just try to read along with me so that you'll have a better idea. So let's see the requirement of this question first. This is basic that I want you to understand. Then we'll go to the advanced level after this. Okay. I hope you guys can see this. Yeah. So if you see the requirement, there is a bigger requirement for 9 marks, which is to calculate net present value planned investment project. So that means this entire information, whatever they have given, it's about you have to calculate what you have to calculate NPV, net present value. So if we read the question starting from the beginning, it says the directors of Pelta company are considering what? Considering a planned investment project for worth of how much? For worth of 25 million, and this is payable at the start of the year of operation. So the moment I have a question, I would always worry about relevant cash flows. What and all is considered as my relevant cash flows. So now the investment value of 25 million will be treated as what? Will be treated as cash outflow. Do you guys agree? Yeah. So investment value of 25 million will be treated as what? Treated as cash outflow no matter what. And they've clearly said it is at the start of the project. So what do you mean by start of the project? So the cash flow happens in today's term. What is today's term? If I go ahead and start the project today, I have to incur how much? I have to incur 25 million. So the cash flow happens on T0, people. What is T0? T0 is nothing but in today's terms. Okay, so let's move and read the next bit of it. So what does the next bit say is we have sales volume, which is units per year. We don't have, to calculate how many units that we are actually considering. So we have sales value, which is unit per year. How much is per year unit, people? Year 1, 520,000 units. Year 2, 624. Year 3, 717. And year 4, 788,000 units. And we have selling price per unit. $30 is what in today's term that we have assumed or we have estimated, sorry. And then we have variable cost, that is $10 in today's term, 10.2 and 10.51 and 10.93 in today's term for next 2, 3 years, 4 years. Now, and we also have fixed cost. Now you see the information needs, whatever the information that they have given, it needs adjusting to take account of selling price and inflation of 4% per year. So that means that $30, what we thought as a selling price, is not in every year value. It is only in today, which year value? Only in the current terms. Correct, people? Yeah. So we have to bring into what value? We have to bring into the future value. Why future value? First you have to get the future value, then only you can discount it to the present value. Correct, people? So I would go ahead I would go ahead and consider my sales in year 1. In today's value is $30. In year 1, how much it would be? 30 plus an inflation of 4%. In year 2, 30 plus 4%. On that again add 4 more percentage. In year 3, whatever the values that year 2 we would have calculated, on that again 4%. Year 4, on year three's value, we will go ahead and add 4 more percentage. I hope everybody is getting that point. Yeah. Okay. Now read the next information that you can see. See, they have given, and there is a variable cost of 3% per year, which is again, what would you do? See, variable cost again, all are given in today's term. So in year 2, if you consider today, I would go invest $10.2 for every unit that I produce. In year 3, in today's value, 10.61. In year 4, in today's value, 10.93. What you have to do? Add inflation for 3% every year. I will show you how to add the inflation. Next, and they're trying to say the year 4 sales volume is expected to continue for the foreseeable future. So from year 5, year 6, year 7, we can expect to have the same value of sales, which is 788,000 units. Now read the next information. We have Pelta company as a company pays corporation tax of 30% 1 year in arrears. What is this 1 year in arrears? See, if I make a profit of 100 today and my tax percentage is 30%, I will not pay the tax in this current year. Rather, I will pay it in the next year. Why? Because if you guys have ever seen, in for the financial year ending 31st March in India also, we pay tax either on 31st July or on 30th September, depending on the nature of business. That means technically I'm paying in the next financial year. Correct, people? Yeah. Similarly here also in year 1, if I make a profit of 100, 30% is my tax, and the 30% will be paid in 1 year arrears. That means next year is what I will be paying. And year 2, if I make any profit, and that year 2 profits would be paid on year 3. Year 3, year 4. So that's how we go ahead and pay tax. And then we also have the company that can claim tax allowable depreciation on a 25% reducing balance basis. So we as finance people, we need to know two things. One which is based on accounting policies, another one which is based on cash flows. So for financial management, do we worry about cash? Do we worry about accounting policy? We worry about cash flows. But few cash flows are based on the accounting policy. Sometimes you should also need to know accounting policy, how that works. See, if I have depreciation, is depreciation treated as your expenses? In your accounting policies, as per your IFRS, we call depreciation is an expense which will reduce your profit. In real life, is depreciation actually happening? No, it is not a cash expenses. It is non-cash expenses. What is non-cash expenses? We assume that is happening because we follow matching concept in our financial reporting. We will go ahead and charge depreciation. Getting people, we will go ahead and charge what? Depreciation. So because of this depreciation, income taxes reduces. That means cash flow is getting affected. So I should know that to calculate my cash flow, which helps me to understand how my finance works. You guys are able to understand the link between these two. So I will show you two methods. Both the methods where you can apply in your examination. Whichever you finds it better, you can go ahead and use that. So let's read the next information. Now, the last information that I have is the views of the directors of Pelta company are that all investment projects must be evaluated over 4 years of operation. That means we assume that 4 years is the end of the operation, and with as assumed terminal value at the end of 4th year of 5% of initial investment cost. We assume that 5% of whatever I have invested would get back to me. Imagine I terminate the project. Out of 25 million, I'll get 5% of 25 million, which can be treated as what? Which can be treated as my scrap value. I told you, you might have another value also. What is that called as, people? That can be called as scrap value. Yeah. Cool. Right. That is year 4 that we will be getting. Now read the next last information that we have. Both the net present value and discount payback period must be used with a maximum discounted payback period of 2 years. The real after tax cost of capital of Pelta company is 7% and its nominal after tax cost of capital is 12%. They've directly given nominal. Guys, until unless they don't mention which cost of capital that you have to use, I would suggest you guys to please use what? Please use the nominal rate. Do not use real. Okay? Yeah. All right, let's get started, everyone. So I know what are all relevant cash flows that we can expect here. So the relevant cash flows is one is investment value. I'm just going to write everything so that I can do working note. So relevant cash flows may, we have investment value and we have sales, right? We have sales to be, but we have to find out what inflated value. That is something that we need to find out. And then we have a variable cost. That is also we have to find what? We have to find inflated value. Then we have fixed cost. Again, is there any inflation to be added for this? I don't think so, any inflation. So you don't have to add any inflation. You just have to bring the cost. And then I have income tax cash flow. For this, I should know my statement of P&L account or my tax cash outflow and savings. Both I should know. Savings happens because of tax. Savings happens because of tax allowable depreciation. Yeah, tax savings happens because of tax allowable depreciation. Correct. Apart from this, is there anything else? I don't think so. Working capital would be given on this question. Maybe I'll try to bring that in the next question that we solve on NPV people. See, these are all I have. I know I have to prepare all the working notes from the beginning. Yeah. Okay. So start from the very first working note that we will start with sales. I know sales, number of units, and I also know what? Let me write the working notes, everyone. So I have first one is what? The very first one is sales or revenue, you can say. I'm going to consider that. So what is that? I would go right. See, terminologies are very important and timing of cash flow is very, very important when it comes to your NPV calculation, people. So what is this timing of cash flows? Starting from, you see, do I make any sales on T0? No. But I would make a sale on T1 and then I would make a sale on T2, then T3 and then T4, 4 years. What is T1? T1 is I assume all my cash flow has been collected by end of the year 1. That is T1. If I assume that is happening at the beginning, we call it as T0, everyone. Yeah. If you assume things are happening at beginning, we call it as T0 in year 1. If assume things are happening at the end, we assume it as what? We assume it as T1. Okay? Good. Now start. What is the number of units that we can expect to be produced and sold? So that is there given in the question. If you see what is the question has given, 520,000 units, and then we have 624,000 units, and then we have what? We have 717,000 units, and then finally we have what? Finally we have 788,000 units. Correct? So I'm just going to align these in the center because I'm just a little obsessive with this, people. I'm sorry about it. So that it looks good. Okay. Now you see T1, T2, T3, T4, we know number of units sold. What is sales price per unit before inflation? You need to write like this, or if you want to write in a better way, you can write it. But I would suggest you to write in this way so that you will also understand. It is $30, $30, $30, $30. So I would write sales price before in units in dollar value. So that we are writing in dollar. A little extra I'll take. Yeah. Okay. Now you have to add inflation. So once you add inflation, what you have to write? You have to write inflated price. With what is inflation percentage, people? Inflation percentage is 4% for sales. If you remember. See, values are in today's term, correct? So 30 multiplied with, if I have to do the compounding effect, you need to understand we are doing compounding here. 4%, there will be an addition. Next, again on that, again on that 4 more, again on that 4 more. So the compounding effect formula can be, can I take 1 plus 4% raised to the power 1. So if I just drag this, for second year, I will go use what? I will go use raised to the power 2. And third year I will go use raised to the power 3, and T4 I will be using raised to the power 4. You see how are we using? This is the way of considering, everyone. Getting? Yeah. So now, yeah. So now what I will do, I will go ahead and little, round off these things. You can keep 1 decimal if you want, or 2 decimal. I would suggest you 1 decimal is more than enough for your NPV calculation, people. Great. So now I know what my sales values, or sometimes guys it's up to you. If you want to keep it 2 decimal, I generally keep 2 decimal. If you want to keep it 1 decimal, that's up to you. 2 decimal is also, that's up to you. So now tell me, what is the total sales value? Yeah, what is the total sales value? Yeah, look at this. I would keep my calculation very simple. I want everything in $1,000. Yeah, $1,000, thousands per year. This is what I want to go ahead and find it out. So I am going to produce 520,000 units, multiplied with my sales price is going to be $31.2, and divide this by 1,000. Why divide this by 1,000? So that my answers are in $1,000. Like I am already calculating in thousands. So that means it is 16,000. It's like 16,224,000. Okay. And I drag it to everywhere. This is how my answer comes. Getting people, this is my sales value. One relevant cash flow I got to know. Very simple. Cool. So now let's move to the next working note, which is of working note number 2, which would be the variable cost. Now you should know how do we work with variable cost by looking at this. All I'm going to do is copy paste this exactly same what we have written here, people. Yeah, copy this, paste it. Not number of units sold. Here it will be number of units produced. Please understand. And here, what, don't write sales price, it will be variable cost per unit before inflation in dollars. So I will write variable cost per unit before inflation in dollars. Done. Over. Now look at the question which is given there. We have 10, 10.2, 10.61, 10.93. I'm just going to write that. 10, oh my god, yeah, 10, 10.2, 10.61 if I'm not wrong. Yeah. And then 10.93. This is what information they have given. Oh my god. Sorry guys. I shouldn't have written here. Yeah. Here. 10 in the variable cost. 10.20 and 10.61 and 10.93. This is what I remember, and just go see that whether it is correct. It is correct. Now how much is the inflated price? Inflation is 3% here, not 4%. Make sure you know that. So here go change it to 3%. All you have to do is just change it to 3%. So once you put the formula, the next table you really don't need to sit and do that. All you have to do is make changes. That's more than enough. So this is my value that I'm getting for what? That I'm getting for my Variable cost. I would go ahead and round it off to the nearest thousands because that will be little better for my calculation. So instead of sales value, write variable cost. Okay, this is about my sales and variable cost. Look at the relevant cash flows that we had a discussion here, people. So my investment value, I know it's very simple. Directly you put 25 million, that's a cash outflow. And sales is cash inflow. We understood how much is sales cash flow. Variable cost, we know. Fixed cost, there is no inflation. Just take the question and you have to put it here. Now we have to know what income tax cash flows. It's about what profit you are making. And it's about what is your tax savings also. Understand, guys, to find out the total income tax cash flow, there are two methods to follow. What are all those two methods? One method is about finding out your statement of P&L account. Or we first start with the difficult method, then we'll go with the smallest one. So what is the third one? I will go find out what is my tax cash outflow. See, where and all I would be having tax cash outflow. For that, I should know what goes to statement of P&L account or what is treated as my tax cash outflow, people. Okay. How does the tax cash flow outflow works? See, for that you should know what is your profit or what is your gross profit. So you already know what is your sales. What is your sales, people? This is your sales. Yeah. So just go ahead and write all of this your sales cash flow. Then less what? Less variable cost. You will be having variable cost. Coming from working note number 2, please give a reference. Yeah. Coming from working note number 1. Oh, yeah, coming from working note number 1. So what is variable cost? This minus this. Now move forward. Then I will have what? I will get contribution, or you can directly write less fixed cost too. It's there is no working note, it's okay. But I can just go write whatever is given in the question. What is my fixed cost, people? 700,000. And then I have 735 if I'm not wrong. And then I will be having what? Why am I deducting? Because I want to find out my operating cash flows, people. Then I'll go deduct 779,000. And then I finally deduct how much? Deduct 841. So these are all the values that I'll go deduct to find out what? To find out my cash flows. Yeah, cash flows before tax. So can I write this is my operating cash flows, operating cash flows before tax. Look at this. So how much is my operating tax cash flows before tax? This would be this much. Yeah. Just drag it down. These are all the values. Now find out on this I will be paying tax, isn't it? Now I'm going to write here. Please understand. It's either T1 or year 1. Please understand. It's T2 or year 2. Please make sure you know this. It's T3 or year 3. It's T4 or year 4. And this will be T5 or year 5. So why am I writing like this? So that you know the timing of cash flows also happens. Okay. So it's not that you just go ahead and write like this and leave it. You should know the timing of the cash flows also human beings. So now understand, I have tax. I will be paying tax on this 30 percentage 1 year in arrears. 1 year in arrears. So how do I consider this value? Will I be paying any tax on T1? No, I will not be paying any tax on T1. Why? Because it is on arrear. I will be paying the next year. This multiplied with 30 percentage I'll be paying. And if I go drag the same thing every year, this is how my cash flows goes of tax. This is my tax cash outflow. You see what is the timing of cash outflow? Timing is T2, T3, T4 and then T5. It is not in the very year 1. Make sure you know this. This is tax cash outflow that I have found out separately. Now, if I need to find out what is my tax savings, which is also treated as cash inflow. This will be treated as what? Tax inflow. I need to know what is my tax allowable depreciation. Why tax allowable depreciation? Because this reduces income tax expenses. This reduces income tax expenses, which is treated as tax savings, then a cash flow. Correct, people? This is how it works. Okay, good. Now, how do we find out tax allowable depreciation? Very simple, guys. It's not your, financial reporting depreciation that we follow. No, not at all. Okay. So, how does the tax allowable depreciation works, everyone? Understand. Okay. So how does the tax allowable depreciation works, people? Look at this. There is something called initial investment of how much 25 million that we can expect, right? So what happens in year 1, I will go calculate depreciation at the rate 25 percentage of writing down allowances or written down balance method, written down balance WD or written down value. So what do we consider writing down balance? What I do, I say 25 million multiplied with 25 percentage is my depreciation. So what is my carrying amount after depreciation, people? Carrying amount after depreciation would be 25 million minus this value. Correct, everyone? Yeah. In year 2, my depreciation would be how much? Year 2, my depreciation, once again at the 25 percentage of writing down balance method. So how do I calculate? I go take this value and I multiply with 25 percentage. Correct? Yeah. So if I have to find out carrying amount after depreciation, this will be my carrying amount after is it so? This value upon this value. So how much is my carrying amount after depreciation, people? Carrying amount after depreciation would be somewhere around this value. Correct? Yeah. Next, move to year 3. This is where most of this year 4 is where most of the students makes mistake. So year 2, I'll go ahead and calculate, and year 3 it will be of how much? It will be of this much. And if you have to calculate this, just copy paste this formula. Now understand, look at this, very simple, huh? Guys, everyone, you need to understand little, a good understanding is required for this. You see, in year 4, will I go ahead and calculate depreciation? See, I will not go calculate depreciation. I will say how much is affecting statement of P&L account. In year 4, there is a scrap value of how much? Scrap value of $500,000, or you can say, not $500,000, 25 million multiplied with 5%. That will be of how much? 1,250 is my scrap value. So can I say that an asset worth of $10,547,000 is getting terminated for just 1,250? The remaining acts as balancing allowances. Acts as balancing allowances. Acts as what? Balancing allowances. How much that would be, people? That would be nothing but this value minus 1,250 would be the balancing allowances that you can expect. So technically speaking, what is my tax allowable depreciation? This is my tax allowable depreciation for each year. I understand. I know what is my TAD, tax allowable depreciation, for T1, T2, and then T3, and then T4. Correct? How much is it? This is my depreciation. Let me just go write it. This is my depreciation or something which reduces my income tax. That's all I know. So how much percentage it will reduce my income tax? By the income tax percentage. Correct, people? Yeah. So what is the tax savings that you can expect? Tax savings that you can expect is 30%. How do you write? So you will not expect the tax savings immediately, only after 1 year, once again, like the way tax cash outflow. So if I go ahead and consider this, you see I will get the cash flows till T5. So I'm just gonna round it off for our understanding, everyone. T5. This is my tax savings cash outflow. See, this is how I find out the tax allowable tax savings. We found out, people. Yeah, very simple. Now what we can do, we can go ahead and calculate NPV. Ma'am, do I have to write once again from the beginning NPV? See, I would suggest you, what I suggest you is just copy paste this from the beginning here, whatever you have. Yeah. So how do we calculate my net present value? Calculation of NPV. Please don't write short forms, people. Find out NPV for Pelta Pelta. So what I suggest is just paste this whatever I have. Go to tax cash outflow. That's where you're bringing in. Okay. Just paste the values. Okay. So I'm writing it T1, T2, T3, T4, and T5 for our understanding. I also am gonna write T0 if I'm gonna have any kind of investment. So write this as particulars. So now write down the tax savings from working note number 4 that we calculated. How much is it? It happens from T2. So just bring this value. Just drop it down. Anything else that we have? I don't think so. Anything else that we have? Just round this off so that the values are not confusing people. And keep all center so that you will also understand what's happening in which cell. Otherwise, it's very, very difficult. That's about it. So tax savings, I got to know what else we have, people. I don't think so anything else that we have. We have few things that we have to identify. One is initial investment. One of the cash flows that we have, initial investment is how much? 25 million of cash outflow. And then we have terminal value. How much is terminal value? 25, it's 5 percentage of initial investment happens in T4. Why? Because our business winds up by T4. It is a cash inflow, so it will be of 1250. Anything else that I have? I don't think so anything that would be considerable. So with this I can go calculate what? I can go calculate my net cash flows. So what is my net cash flows? Sum of, take from operating cash flows. Why? Because we have already calculated and kept right those things. So take from operating cash flows, just drag it. I believe you should also be getting the same value. Yeah. So net cash flows, this you have to find out what? Discounting factor. Don't write DF, write full thing, full form. Discounting factor at the rate of 12 percentage. So how do you calculate? 1 divided by 1 plus 12 percentage raised to the power 0. Since T0, write 0. But next years you have to write T1, you have to raise it to T1, T2 you have to raise it to T2, T3 you have to raise it to T3, 2, then I'm raising it to 3, and then I'm raising it to 4, and then I'm finally raising it to 5. So always keep your discounting factors of just 3 decimals. That's more than enough. Why? Because we calculate in thousands, so 3 decimals should be fine. Okay. So discounting factor. Now I'll go find out the discounted cash flows. All you can write present values. Whatever you feel like writing, you can write this. Okay. So multiply the net cash flows multiplied with the discounting factor. So drag it to all the years. Just if possible, just round it off. Yeah. So once you round it off, what happens? We can go ahead and find out what? My present value, NPV. What is my NPV? Sum of all of this. My NPV would be, the whole value to be of 10,474. See, ma'am, I got something else. I got something different. It's totally fine. If your NPV is somewhere close, they will give you marks. You really no need to have value, everyone. Understand, not required. Uh, Correct, yeah. Okay. Do not worry. Sometimes they will give you the discounting factor. Sometimes it's suggestible to take the discounting factor which is being given by the question itself directly. Okay. See, I would, if you want to put a border, please put the border. Yeah. But make the presentation better if you have time at the end. Don't sit and waste your time if at the beginning. Okay. So this is how I will go do the calculation for the 9 marks. Simple, neat, clean. Okay. Now the point is, ma'am, you told another way of doing no statement of P and L. What is that way, ma'am? See, it's very simple. I should know what goes to statement of P and L, what comes in, you know, statement of P and L. If I know that, it should be fine. So you should know how does a statement of P&L account works. It's the same answer. You can go write it in another way. I'm just going to write it on the next slide so that you know how that works. See, I'm going to prepare these two. Okay. So I'm going to prepare these two. First, as usual, like this is another way of writing the same answer. So I'm just going to write it like this. You're just aligning stuff, people, so that you know. So I'm going to keep, I know since I'm going to take these calculations, most likely I'm just going to center it by default right now. Yeah. And I will just go round it off. To keep two symbols, yeah? Similar thing here as well. We'll keep two. I know sales and I also know variable cost. Now what I do, I will bring this. I will not calculate tax savings. I will just bring this tax. I will write tax allowable depreciation overall. This is what I want to know. Okay. This is my third working note that I prepare if I'm writing in statement of P&L concept. I will write tax allowable depreciation. That's all. Again, I'm rounding it off. Done. Over, over. Done. Ah, done. Cool. So now tax allowable depreciation is done. What I do next thing, fourth one, to calculate my tax cash outflow, net tax flows. What I do, net tax flows. What I would be preparing, I would be preparing statement of P&L to find out what is my net tax cash flow. So how do I get to know? All you have to do is just take the same thing what I have written here. Yeah. So I'll just take these things, not anything else. Then to this, what will I do? I will go less depreciation as well coming from working note number 3. This is how I go ahead and do. So now I know working note number 3 mein how much is my depreciation, people. My depreciation I will reduce in statement of P&L. 6250, and then I'll go reduce how much? I will go reduce 4688, and I'll go reduce 3516, and then I'll go reduce how much? I go reduce 9297. These are all the calculations that I do. Now what happens? I will get to know what is my profit for the year. What is my profit for the year? Take the sum of all of this. Correct, right? Yeah, this will be the profit for the year. I know the profit for the year. On this, I will be finding out the net tax cash flows. It will by default be outflow only. Okay. So overall outflow will be of how much? It will be on 1 year arrear. It will be this value minus 30%. And I go do it till T5. Oh my god. Right. This is how my net tax cash flows works. So I know what is my net tax cash flow. Yeah. So with this, I'll go prepare working note. Like I'll be able to calculate what? I'll be able to calculate my NPV. What do I do? Just take the same copy paste here. Yeah. Instead of writing tax, operating cash flows and all of that, what do I do? I'll go write the, look at this. I'll go write what? Tax, net tax cash flow coming from working note number 3. I know how much is it? From T2, T3 onwards it happens. Then I'll drag it. subtract over. Then what happens? I will go find out my I will go write my initial investment. How much is the initial investment? 25 million. Then I'll go write scrap value or terminal value. Let me write terminal value. T4, how much is it? It will be 1250 as we already discussed and calculated. So I'll go find out my net cash flows. This is another way of doing. However, as I said, it is up to you which one you want to choose. If you find out the net cash flows, you have to take the sum of everything. To take the sum of everything. So when you take the sum of everything, I'm 100% sure you'll get the same values what we would have calculated here. It is not something different. It would have been the same. It was 25 and 1 10 million 168 11 5 85 12 6 8 2, the same thing. So what I will do, go find out the discounting factor. It is going to be the same thing. Yeah, done. That's how you'll get the answer. So this is the second method of doing what? Second method of doing your NPV. I believe you guys understood, and I believe like you have two different methods to follow. Whichever method that you want to follow, you can go follow that. So we are clear about the requirement number 1, which is for 9 marks. So I've given the tactics to follow. It's up to you. Now the second one that they've asked us, they asked you to calculate the discounted payback period for the planned investment projects. How do you calculate discounted payback period, people? With the help of discounted cash flows. Correct? Yeah. So we know already discounted cash flows. So we have discounted cash flows. All we have to find out are discounted cash flows. How do you find out? For that, you have to calculate cumulative discounted cash flows, people. So what happens? What is my discounted cash flows? What is my discounted cash flows? So go write. I'm just going to write here T1. Yeah, T1. I'm going to get so much. T2 and T3. And then T4. I'm going to get so much. T5. I'm going to get XYZ. See, what is my initial T1? How much I'm going to get? I'm just going to copy paste this, people. This is the values that I can expect to have. Just drag it. Including this. See, I should know where it is becoming 25 million. Okay. So identify first thing. So 25 million have been invested. Correct? Yeah. How do you find out cumulative? All I have to do is take 25 million, add this value so that I know how much extra I'm still yet to receive. Correct? Yeah, I'll get to know how much extra I'm still yet to receive. In T2, see, I'm yet to receive this much, but I got this much. Correct? In T3, I'm yet to receive this much, but I got this much. So that means my values are going positive somewhere in T3. Correct, everyone? Yeah. So you need to know, I have taken 12 months to generate the cash flow of how much? Cash and flow of $12,682,000. How many months? How many months? will it take to generate 3,247,000 to make the project no profit, no loss, no gain, no loss? That's when we call it as payback period, right? No gain, no loss. So how many months will it take? So 12 months have taken to generate $12,682,000. How many months it will take to just generate 3247? That's when it becomes 0. If I go ahead and do the cross multiplication, it will be 12 into 3247 divided by this value. It will be of how much? 3.072. Correct, everyone? Yeah. So when I go ahead and do this, what is my discounted payback period that you can expect? What is my discounted payback period that we can expect? Oh yeah, I should have taken discounted cash flows. I'm so sorry, guys. It's my mistake. Yeah, it should be this, and I'll just drag it down. So, okay, yeah, got it. Right, it's my mistake. So that means I have to just change here T39027, and here it will be 2341. I'm sorry about it. Yeah, is it correct? So this will be this. Oh, very much right. 6686. Very much right. 2343. Very much right. So it has taken 2341. It has taken. I've taken 12 months to generate a cash flow of how much? Cash flow of 9027. How much will I take to generate the whole value? Okay. So it will be 2 years and 3 months approximately. Discounted payback period would be 2 years and 3 months approximately. I hope we are clear about it. Yeah. Requirement number 2. Now look at requirement number 3. Discuss the financial acceptability of the investment project. It is for 3 marks. So ma'am, what I can go ahead and write as marks. See, you need to understand NPV is positive and the discounted payback period is greater than what is your maximum target discounting period. Because in the question at the beginning, they've clearly said this project, this company has the maximum discounted payback period of just 2 years. They don't accept anything more than that. Okay, so that is two things that as a finance manager that you have to sit and analyze before you make the decision. Correct, people? Yeah. So we will go ahead and consider three things. What are all those three things, people? The three things that we would be considering is one value would be the value of the amount which is getting back. NPV is positive. The second thing is payback period is more than the visibility that we have in the business, right? And third thing, now the correct advice is NPV method. However, you also need to know the investment project is financially acceptable. We can go do it. It is just matter of 3 months. So we can go tell them that please accept the project. So you talk about NPV 1 point, you talk about discounted payback period 1 point, and then you tell that go ahead and take the project is another point. You'll get 3 marks. But you see, look at the next requirement. Critically discuss the views of the directors on Pelta company's investment appraisal. Guys, if you know what we have done, it's more than enough for you to go ahead and consider. What is it? The sales are expected to go more than 4 years, right? Yeah. One thing that you have to talk about. So the evaluation period, it is more than 4 years. So the director's viewpoint is all the investment projects must be evaluated over 4 years of operation. Sometimes it is not sensible. Why sometimes it is not sensible? There are projects which goes more than that. There are projects which just winds up in 2 months, 2 years. So the director's viewpoint of view has to be changed on this perspective. Correct, everyone? The director's point of view has to be changed only from this point of view, this perspective. Why? Because there is always a chance where this doesn't work out. Correct? You explain this briefly, it gives you 2 marks, 2 points. Are we clear about it? Yeah. And then we move forward about the assumed terminal value. See, understand, we say 5% of the investment value is going to get terminated. It is just an assumption. It is just expected. There is nothing that we have a clear cut visibility like what exactly is my terminal value. The prediction or the estimation that you make should be somewhere close to the understanding, should be somewhere close to the realistic value at least. Okay. So apart from these two, there are other things that we have to consider about on the investment, terminal value of the investment itself. The point is, see, there's no fact. And you need to understand, guys, like we are talking about the project will appear with future sales, but you're telling that the terminal value 5% you can expect. How do you financially say that there is a project which is going to get wind up and still we will get terminated? That is something the director's view has to be changed. We have spoken about 4 points, but for 6 marks. So then comes the discounted payback method. See, why the discounted payback period is not more than 2 years? Why do you think they're keeping a target of just 2 years, which is not so viable or which is not so, considerable in the market? Why do you think so? Right? So this 2 years that they're trying to keep it very less certain, but sometimes it's you have to take little more extra values, because simple payback period will not give you the exact value, right? It's better to keep 2.5 years or you know um, um, you know exactly, the values are very very difficult, and the risk is you're keeping the lower risk because earlier payback period will have low risk, you know um, longer payback period will always have higher risk. Correct, everyone? Yeah. So that is how we have to go ahead and analyze the project. That gives you the entire 6 marks. So this is a whole good question that you can expect to have a 20 marks with, I would say, there are 11 marks which has been asked on practical and 9 marks which will be asked on what theory. So what we can do, I would expect to solve a bigger question than what we have solved today. So it might help you to, today's session will be helpful for you to understand tomorrow's calculations. So this would help you to have a better analyzation. Okay. Yeah. So we can go ahead and identify those things at the end. All right, people. So thank you so much for attending the session. And if you guys have any questions or any doubts, like after you watch, you can just drop it on the comment section, or you can try getting in touch with Lotus team to have a better understanding about the financial management course. Yeah. Thank you so much. Take care, guys.